Good evening, ladies and gents. Let everybody log in on this reasonably sunny afternoon, wherever you are in the world. Hope it's pleasant. Hope you are enjoying your Tuesday so far. Okay, so let's get stuck into it straight away, because I want to leave time for some Q&A. Welcome. Thank you so much for joining me. I appreciate your time. And I'm going to make it as valuable as possible. Just double checking my audio is good. Looks like we're okay. Anyone has any problems, fire away. There's a questions section somewhere on your GoToWebinar where you can ask a question. Anything you don't understand, absolutely, please ask the question and I'll get to it at the end. I normally do wait until the end so that we can go through everything and maybe it's answered later on. If it's not, then we'll get to it and I will absolutely try and give you the answer. If I can't, then I will, hopefully be able to point you in the direction of someone or somewhere that can. I've been trading for a couple of decades, but I don't claim to know everything. I know a reasonable amount. The market's been kind to me, but I don't know everything. So I will try and help you out as best I can with that. All right. So those who don't know me, I'm Mark Holstead, trading for, like I say, 20 plus years now. And you've probably seen me before. If it's not your first time, then welcome. If it is your first time, welcome. If it's not, welcome back. I do a daily email, tradersmastermind.com/email, podcasts, was on YouTube, so lots of stuff going on. Anyway, today we're going to talk about gap trading. Before we get on to that, I want to thank you, gents, for your audio check there. Leslie and Andre, appreciate that. Okay. Disclaimer as usual, please, spread bets, CFDs, etc. Is a risky business. We know this. You should know this. Please understand this. I know we always say this every time, but hey, we have to understand what's going on in this game, and it is a risky business with a lot of upside, but there's downside there too. All right, so let's get started. So I am going to talk. This is a two-parter. There we go. And I know a lot of people don't trade products that gap. A lot of people trade Forex, right? In the Forex, you only get the gap, the Forex. In Forex, you only get a gap the weekend potentially, right? But this is apt for people who are trading indices, is apt for people who are trading shares, also Forex as well. But what I want you to think about is that actually, this could be something that supplements your existing strategy. So if you like trading the currency pairs, if you like doing that, then this could be something that you screen for and add in addition. So you have an additional strategy that you bolt on to your current way of trading. But maybe you go, okay, listen, this isn't going to occur all the time, but when it does occur, I can focus my energy on that. Just adds another kind of arrow to your quiver. It just allows you to a bit more rounded trader, but also as well, it's going to be applicable for if we get some news at the weekend and what euro's gapping up or dollars doing something or other, then the same sort of thing applies. So I feel like it's valuable wherever you are in your trading or whatever you're kind of trading. So this is a quote from Jesse Livermore this time rather than the Stoics. Those of you who haven't read Reminiscence of a Stock Operator, absolutely recommend it. The desire for constant action, irrespective of underlying conditions, is responsible for many losses on Wall Street, even among the professionals. And isn't that a perfect quote? How many times do traders get sucked into overtrading, trading markets that aren't really that great conditions, and you're kind of looking at it going, it's all right, it does the job, and it's just, it just doesn't serve you. And so it's waiting for those right conditions is key. Well, whatever you're trading, whatever industry you're trading, whatever methodology you're trading. Okay, so a quick run through what we're going to do today. Part one is today we're going to talk about momentum, and the whole objective here is that I want to give you a framework that you can take away, make little adjustments, and make your own. And like I say, this is going to be new for many people. Gaps maybe don't fit into what you trade at the moment, but I think understanding the opportunity here is going to maybe go, oh, there's a few light bulbs going to go off. So today, this week, or literally today, not this week, today, week one, we're going to talk about identifying the type of gaps, and then how we can basically build a framework where we identify the gap type, and then we put together a plan of action for trading that gap type and how we get into that trade. So a step-by-step process for trading gaps, because gaps are really interesting. I don't want to jump ahead of myself, but they're really interesting. I'll explain why in a moment. So this week we'll talk about momentum, and then next week on Wednesday, we're going to talk about fading. And so fading the gap. So we've got either gap and go, which is kind of as the market gaps higher we go long, or gap lower we get short. And fading it is basically the traditional gap fill methodology. We screen for the gaps, a V-shaped reversal, a little bit about adding to winners, adding that on there, and also this gap fill testing tool that I've got for TradingView. I'll give you access to that. Those of you who've been on before know that I really like developing tools to dig into ideas and strategies. So it's not sort of a standalone thing that you sit there and chugs away, but I did an opening range breakout engine, I called it, and it's a tool for testing out different opening range breakout parameters, like where do you enter, where's the stop, where's the exit, how wide does the opening range have to be, and you can get a free copy of that at tradersmastermind.com/ORB if you haven't already got that. And like I said, these things, I work with a developer. He's very, very good. And I'm happy to share these with you guys because, I'm not going to hoard all this stuff and go, I've got this tool and no one else can use it. I think it's, it's cool to share these type of things. So yeah, I work with a developer and we code these together, but it helps me kind of think a little bit more clearly and not so discretion and so down that road that I'm always on of discretion and price action, this and that, and say, okay, put some structure behind it, put some logic behind it. Let's test some different ideas, some different gap directions, some different tools. Anyway, so next week we'll give you access to that. And like as always, I want to do that at the end, really, so that we get the concept of what we're trying to achieve and then how that tool can support you on that journey. And really, all these webinars, I like this, guys. I kind of try and dig into a topic as much as possible. Show you the process, the framework, the strategy, and then if there's a tool there that I've got and I've had built, then I'll share that with you. So you get the complete kind of way you can take it and go, right, how does that fit into my trading? And some of them won't resonate with you, but hopefully some of them will. And that's really what I love trading. I've been trading for a long period of time, and I love talking about trading. I love sharing things that have helped me. I love talking to other traders. So I've got a lot of stuff that I can share. Okay, so what is a gap? Let's get rolling. So what is a gap? A gap is really the difference between the opening price and the prior day's close. So this generally happens, with just oscillations of the market, or it could be a news release that comes out when the market was closed. So you think about, I know a lot of people think of sort of traditionally shares as gapping, but actually indices can too. Now, obviously, if you're trading with Pepperstone, they're going to offer you the Dow 24/5. And you're not going to see a gap. But actually, we know that the Dow or the S&P or the NASDAQ is based on underlying cash instrument. And there's a futures instrument that supports that. It can get a bit complicated. I think most people are intermediate advanced traders here. But really, we're looking at a regular trading hour session. So a good way of quantifying that and looking at on a chart is to use the SPY if you're trading the S&P 500, DIA for Dow, QQQ for NASDAQ. If you're trading the shares, then obviously it's going to be the gaps. USO maybe for crude, I guess you could use. So we're just kind of trying to find when there's a big kind of lull in volume, and you can do this with FX as well. And something I perhaps should include on the slide, but if you're trading a currency pair that is, let's say, the USD JPY, so Asian session and US session are perhaps going to be more active than the London session because it's a product that's based on the dollar and the yen, right? So those two sessions are going to be more active. So you can still kind of manipulate and adjust this. And this is where it gets exciting, right? For you to go, hey, I trade this instrument. Can I use what these type of traders use over here and bolt it into what I do here? Because that's where you find edge. That's where you find edge. You go, hang on a second, but if I treat that as the gap and I use the London session as this, and I use the Asian session as when it's closed because there's not much volume, and I think of it like there's just different ways you can think about things. So all explore, dig around, explore, go down rabbit holes. That's what trading is all about. So it's a difference between the closing price and the opening price. So why do I think it's important? So I think it's important because it's a really, really, really powerful tradable opportunity, because you've got this massive imbalance of supply and demand. Because if you think about what's happening with price, any instrument, let's just think of, regardless of what it is, let's just imagine the market's closed, close at $50, whatever it is. The next day, if it's opening up at $55, something has changed with the supply demand. There's a lot more demand that mean that participants have come in and decided to pay 10% more for that asset than they did yesterday. So something's changed. And as traders, intraday traders, active traders, we want to capitalize on supply demand imbalances, right? This is our job. Our job is to look for those imbalances, look for, you remember a couple of webinars ago talking about institutional order flow, time sensitive versus price sensitive. If we are trying to find people who are time sensitive, i.e. they want in now, they've got market orders, they're causing the market to move. That's what they're doing when there's a gap. They're like, I just need to get in. I don't care about the price. I want to get in now. If we can spot those participants, that's how we can potentially make some money, because we are watching, seeing that time sensitivity. They need to get in. They don't care what price, that moves price. So it creates these potential intraday trade setups. And those of you who kind of do like to move around with the flow and go into instruments that are maybe in play, for want of a better word, that when there's a bigger supply demand imbalance, those markets are much more movement. There's much more rotation. There's much more potential opportunity. Now, let's change topic very, very quickly. I do believe that you can become a specialist in either the instrument you're trading or few instruments you're trading, or the setup. And this is when you go, hey, I'm a specialist in the setup, I'm a specialist in gaps, large gaps, and I like to take advantage of the large gap supply demand imbalance. Okay, so let's keep moving. So today and today and next week, I want to give you a gap trading framework, right? And again, take it as you want, take it, leave it, do whatever you want with it. But the way of thinking about a strategy, I think, is one of the key things that's missing for many traders. Is you've got the strategy, and there's loads of effective strategies out there, but it's how you think, your mental model of approaching these strategies, and how you can then implement them to your trading or discard them as you see fit. So we want to build this framework, and the steps, really, we're going into a lot more depth here, but the summary of these steps is we're going to identify and categorize the likely gap type, and we'll talk about how we do that in a moment. Create an intraday roadmap or plan for executing where we believe that price is going to go. Look to take their position with a trade trigger. So there's no point in having the roadmap of saying, oh, I think it's going to close at highs, I think it's going to touch this level, whatever, unless we've got a reasonable trigger with a quantified risk to get in. That's when we are chasing stuff, when we're getting caught out. And the fourth final thing, obviously, is managing the trade. So it's a very simple framework, but actually I think that you can take this framework and way of thinking for many ways that you trade. Like, I mean, if we take gaps aside for the moment, let me categorize the day type. If you come in and you're trading GJ, or coming in, you're trading a cable or any of these, and you say, what's the day type? Is it kind of range expansion? Is it this? Let me think of an intraday roadmap or plan. How do I position? What's the trigger to get into the trade? And how do I manage the trade? All right, so let's just really quickly go through the types of gap. So there's that glorious candlestick there that's been drawn for you. Imagine that that's a standard candlestick. You've got your open here, your close here. It's a high of the day, low of the day. Imagine it's a daily chart. Now, there's the close there. So the next day, if the market opens at any point below that close, I consider it a gap down. Now, I call it a range gap down, and there's probably a terminology out there for it somewhere, but I just make these things up because I think it makes sense. If we gap out of the prior day's range, so the prior day's range low was here, prior day's low was here, prior day's high was here. Now, if we gap outside of the prior day's low, that's to me, it's a range gap. It's much more powerful, right? If it's breaking below and opening below the prior day's low, that's pretty weak. So a gap down is anything in the body, or in the body and the low, and the range gap here. And then the same to the upside. A gap up will be anywhere between the high and the close. And if we gapped up above the high, it will be a range gap up. And so they're more interesting to me. If you're going to filter for stuff that you believe is more interesting and presents potentially more opportunity, that will be how you'd filter. And we'll get into filtering later on. But just thinking that in your mind now of, okay, a little gap down, just opens within the body. There's not really much. We're not really that interested in that, and we probably wouldn't take kind of a momentum trade with that. Again, we'll go into more depth with this, but that's just something to think about as we go through these slides. And a few examples I've just pulled here. There's our open, there's our close. We've got a gap up. They actually got filled on that one. Then we've got this one here, closing here. We've got open here, a little bit of a gap down and closed here. Here is a range gap up, so it's gapped up above the Friday's high. There's the open, and here's a range gap lower. So there's a close there, and it's open right down here, hasn't it? So different types of gap. Okay, now let's dig in a little bit more, and let's use the textbook for a little bit, because the textbook's okay. Because you know, people who've traded before us 100 years ago, 30 years ago, 50 years ago, gosh, 20 years ago would be me, but this is stuff we can learn. So there's nothing wrong with the textbook, but I always like to think, how can I take what is traditionally known and make it my own? Because I think that's where we create edge in the market. We do what everyone else has done and doing, we get the results everyone else gets, which isn't great. We need to think differently about things, but this is valuable to kind of have this framework. So a breakaway gap is a gap that gaps above some price structure. Examples in a second. So imagine a range, you've got a range, the price gaps above that range. Technical pattern has been broken, okay? A common gap is just a normal everyday gap that's likely to be filled. Maybe it's in a range, maybe just gaps up a little bit. It just happens. We're always going to get gaps on something that closes and opens. They might be small, they might be large, but it's just a common nothing going on gap. Exhaustion gap is at the end of a trend, that last gap up. So we've had a good strong trend, persistency of trend, and at the end we've got one last gap, and it's almost like it's the buyers who maybe are stuck short trying to get out, or there's FOMO. It's just that real, you know what, when that supply demand just literally goes right to the end, and it's the last one, and everyone is fully emotional in it. They're super time sensitive. They've got to get in or get out if they're stuck short, and it's that last like just big exhaustion gap, and it just freezes and it just kind of rolls over. We're going to look at those type of ones next week. Today we're looking at the breakaway gap and the runaway gap. So this extreme supply demand imbalance, and a runaway gap, by the way, is in the trend. So the trend is running, and then we kind of get this gap where we're just kind of momentum is moving. Now, it's very easy for us to stand here and go, oh, that's a runaway gap, that's a breakaway gap, it's a common gap. That's hindsight trading. We're not hindsight traders. It'd be lovely if we could look at the chart, the S&P 500 or of a GBP USD and go, okay, that's what happened, I'll trade that. But we can't do that. So we have to make our best guess. And this is what we're trying to do. We're trying to categorize the gap type. And step one, and we talked about in the first couple of slides, was let's categorize that gap type, and then let's build an intraday framework. And to categorize the gap type, we look at some clues. So, and hopefully you can start to see now in your brain, go, okay, well, actually, if I do get that category right, and it's a breakaway gap, then yeah, if I do follow the gap and it's a gap and I kind of trade the momentum, that's going to be much more profitable than me trying to trade a gap fill. And so categorizing the gap type is a big missing piece that a lot of traders, I believe, don't do well enough. You don't spend enough time thinking, what is this? It's a $2 gap. Yeah, but where in the structure is it? What's happened at the left-hand side of the chart before this? What's built up? What are all our participants doing? Are participants stuck? Have we seen a big price movement? Have we seen stagnation? What's happened? Is it catalyst? You know, why is this gapped? And what does it mean for the average long, the average short? When you can calibrate your thinking in that way, I believe that unlocks a whole new level of trading. When you can calibrate your thinking into, hey, what does this really mean? Let me just stew on this thought. What does this actually mean? What's happened before? What are players thinking? What are other participants thinking? Why would it do this? Then we are in a far better position, a far better place, should I say, to position. Okay. So let's have a look at the different gap types, some examples. So breakaway gap is a gap that changes the structure, breaks out of a channel, trend, above resistance, below support, just some technical structure that you know and you see on the chart, and it just completely ruins that structure. It gaps through really key level. And you know, maybe it's a large gap percentage. That's normally a clue that it's a breakaway gap. The obvious technical pattern broken is the biggest thing. And there's a good kind of initial move, right? It's a good break. So example would be, here's one on Tesla, right? We've got a little downtrend channel there, and it's broken the structure. It's the downtrend, everyone's happy, chug, and all of a sudden, poof, we get a gap up above that channel. So that would be a breakaway gap, something that's broken the price structure. It's broken that downtrend. It's the gap that's caused the break of that downtrend. All right, common gap, pretty dull for what we're talking about now, which is momentum, but actually quite interesting if we can, you know, next week, if we can find the sweet spot of a gap that's worth fading and we can still categorize it as common gap, That's when we trade the gap fill strategy, but more on that later. These are regular occurrence, right? Just do order flow, just nothing going on, no real supply demand imbalance, likely to fill within certain parameters. Small gap percentage, no real catalyst. And by the way, a lot of these gaps are caused by catalysts. There's a news event, there's earnings, there's something that's changed the fundamental valuation of that asset. The asset has been repriced. Based on that news. And a way of thinking about it is, if you may not trade equities, but to think about company earnings, it says, hey, we're expecting this, and now they've beaten, and they're earning 20% more than we expected. That's going to revalue the price of that company. That company is going to be valued more just instantly. And it's the same. We get this very often with currency pairs when we're trading CPI data, or we're trading over interest rate announcement or something, or jobs number, NFP or something. It's not an instant kind of gap because it's actually allowed to trade through it. But this is why we get a reprice scenario sometimes when, if something comes up way hotter than expected, all of a sudden everyone knows what that means. That means the interest rates are going to do X, Y, Z. And so the price of that asset has been repriced immediately. So it's a reprice scenario. A small gap percentage, no catalyst, daily chart structure intact. That's one of the key points there, that the daily chart structure is intact. It's a theme here, and I'm pressing the point without being an idiot about it. I hope is that the left-hand side of the chart really builds the picture and allows us to build this framework. What we're seeing and how the price is behaving up to that point really gives us the clue. And this from your day trading something. If the price is sitting there in a range doing not a lot, you take a trade, you end up twiddling your thumbs watching the price go green, red, green. It's a completely different trade to something that's ripped off, flagging, dips below the flag, then just pops, you take the long. It's a different feel. Even though the price might be identical, the actual price level, it's a completely different feel to the structure. And so that's super important. Okay, common gap here. We've got SPY. There's loads of them on here. I could have just picked anything out of this. For some reason, I picked that one. Maybe it's the one that stood out the most. A little gap lower, right? We've closed at lows. We haven't closed at lows. We've closed at about 75% of the range. Little gap lower. That's a common gap. There's plenty of them here. These are all kind of common gaps, really. And that's a lie. They're not all common gaps. There's lots of common gaps in here. Where we close, we gap lower, closed here, gap lower, closed here, gapped a little bit higher. There's nothing much going on, right? And they're very likely to be filled. Okay, so, and this one obviously was at some point because the high went through here. So let's look at the exhaustion gap. So again, exhaustion gap is the end of a trend, very extended move, persistency of trends, steep trend. You know the score, you've seen these trend moves happen, and it basically gaps and then it reverses or it stagnates. So in other words, it gaps up. We don't get the continuation you do with a breakaway gap or a runaway gap. You get a kind of exhaustion move and it just sits there. Again, we're going to dig into this much more, this mean reversion approach to gap trading on Wednesday, week on Wednesday. But I want to get the framework out there now so we get into our mind of, hey, how do I categorize this gap? What's the best guess I've got for this gap? Because if I can get that part right, everything else is a little bit easier. Just like when you're coming into the day. You're coming today, you're ready to trade. What day type am I expecting? Rotational? Are we going to be oscillating around a sort of mean? Are we a trend type day? Are we going to have two-way trading? How do I frame that? Because that's going to help you then position. Do I wait for extremes to fade? Do I want to jump on ignition moves? How do I want to play that? That's a really good place to start. So clues exhaustion gap is occurring at the end of a big move and very overbought or oversold conditions. If you're using something like a stochastic RSI, CCI, any of those oscillators, you're going to see those very, very extended. And then you go, okay, that could be an exhaustion gap. How does it respond? Oh, it sits there, stagnates, etc. Or does it reverse? How do I look at it? And there's an exhaustion gap here. Again, Tesla, the gappy little stock, right? There's a lot of news flow on it. There was any years ago. I think it's from a while ago. Gaps up. Real strong trend, real overbought, and you're done. Okay, runaway gap, let's go. Gap in the middle of a trend. It jumps several price levels, real supply-demand imbalance, and there's often triggered by a reprice scenario earlier on. Might not be immediately there, but it might be, hey, there was a reprice, a good earnings, a hot CPI number, poor jobs number, something, and it's caused this asset to kind of just rip and rip and rip. Existing strong trend is a good clue. Not at the beginning or end of a move. Now, that sounds like a hindsight trader, right? Well, you've got to be not the beginning of the end of the move. How the hell do you know it's the beginning of the end of a move when you're on the hard right face of the chart? And this is the trap that a lot of people can fall into. You don't know. But if you can say, hey, we have just started the move, maybe we've had 2 days of gap or 2 days of run, and there's still some room to breathe. We're not that overbought yet. We're not that oversold yet. You probably can categorize it as in the middle of a move. Again, we this is the thing. We're never going to be perfect, right? We don't have to be. That's the beauty of it. We can make our best estimate, position for that, stick to the rules of the plan that we're going to execute, manage the risk, and let it play out over a number of times. And we get better at it with experience, but we never know completely. And anyone says, yeah, you must do this. It's not true. You don't have to be perfect to do well. You just have to be good enough to take the high probability chunk, from the market. And here's a runaway gap here. Start of a move, big power, just start to go, broke out that base level, start to push higher. And it's not really the end of the move. You couldn't say it was the end of the move yet because it's not really got going. And again, I don't want to sit here and say you should see that obviously it's a runaway gap or this gap. It's not always going to be clear, but we're trying to make our best guess. And that's the thing that's important with trading. We're trying to make our best guess. Once we've committed to that, we need to flood ourselves with certainty that that's the right call and then execute the plan. But if the risk is managed, it doesn't matter if we're right or wrong. We just have to be, executing what we say. The worst thing we can do is go in and think that the market condition is one, and then flip-flop back and forth during the trading day. If you're a day trader, you go in thinking, okay, USD JPY is going to be a trending day, and then like, no, I'm going to fade highs. You just get in a mess. Commit to it. Decide if you're going to change your mind at any point on what metrics they'll be. But otherwise, keep committed and stick to the plan. Sticking to the plan is such a key part of the game. All right, so we identify the two aggressive gap types, the runaway gap, the breakaway gap. We're not interested in the common gap for now. We're not interested in exhaustion gap. Once we've had those clues, and we went over the clues, I won't go over old ground. Let's say we've said, okay, you know what, that looks like it's a breakaway gap. It's broken out of structure, this, that, the other. Okay, all right, I'm going to mark that as a breakaway gap today. Now, how can I trade this? We don't just go in and fly by the seat of our pants and going, it's a breakaway gap, I'm just going to buy. No. Let's be more strategic than this. We want to be generals on the battlefield. We don't want to be on the front line. Sometimes we get sucked into trading and kind of battling away on that tape and that short-term price action. But we really must make sure we step back, observe, and think of deploying capital as troops. So if you're a general, you're deploying your troops to that battlefield where you believe you've got an advantage. And then if it's not working and you feel like it's just not working until you pull out, that's your stop loss. You save capital, you save your troops. And so, we want to be the general, the CEO, if you like, however you prefer to frame it in your mind, and think of a plan of action for the trading day. So where do we expect this price to go? And this is something that's going to come with time, but do we expect it to close at highs? Well, why would we expect it to close at highs? Is it a big structure break? Is it a big catalyst? Any clues in the open that we can look at? Do we expect this price to hit a prior resistance? Maybe it's a whole number in crude oil. Maybe it's a whole number that everyone's looking at. Maybe it's a really big level from before. Maybe it's a prior, all-time high. Maybe it's a weekly high. What is it? Is it an ATR, i.e., an average true range or an average daily range? Is it something? Just I'm a big fan of reverse engineering the target and going back from that, because that helps me stay in the trade. And I think it'll help you too, where you say, okay, this is the day type, categorize the day type. Right now, where do I expect this to go? This should close at highs today. And again, we're making our best guess, guys. We're not crystal ball here. We're making our best guess. Okay, so now I've got two things that I believe to be true about this market. And we get better at that as we go on in our trading career, ultimately. But that's what we're trying to build. So then the question becomes, how can we jump on board this trade in a structured way? And I probably should have added, the least amount of risk possible, because ultimately, what we're trying to do is make the most amount of money possible with the least amount of risk. That's the name of the game of an active trader. Right? I'm not trying to outperform the S&P 500. I'm not trying to make a few base points over what you get in the bank. We're trying to make good chunks of money on our deposit, and it doesn't always work. But that's the framework we should be constantly thinking of. How can I make the most I possibly can, but risk the least amount. And of course, we must manage the risk, and of course, we're going to get stopped out a lot of the time. But that's often what we should be doing, and hopefully that stops us from taking substandard trades. Okay, so trade triggers. So now we've come up with a framework. We've identified the gap type, or we've made a best guess. You've estimated where we believe that market's going to go. Now we want to know how to get into the trade, because we don't want to just be buying at the open or buying at highs, because how many times have you done that? You've thought the market's going to do this, you buy it, then it just comes lower and lower and lower and lower, stops you out, and then continues in your direction. We want to be smarter than that. We're going to let other people mess around and get FOMO and get sucked in based on emotion. No. We're going to be more strategic than this. So we should have some trade triggers that we use to maybe get into the trade. Some ideas for you. Opening range breakout. This is a great way of combining two strategies to improve their effectiveness. So rather than trading the opening range breakout every day, you might say, hey, I'll take it on a day I believe we're going to close at highs. And one of the days I believe we might close at highs if we get a breakaway gap that breaks out of structure. Or you could have other reasons why you take that. But then you go, okay, well, I'll take the opening range breakout. I'll take a 15-minute range and I'll buy above the high. I won't take the short, but that's what I'll do. So you're molding stuff in. You're building a real good playbook and a way to operate on the battlefield. Prior candle break. We'll look at the examples in a moment, by the way. Reversal candle. So prior candle break was like other facts. I'll show you an example. Reversal candle, trend line break, high break. And whichever trigger you use, the stop should be a key factor, because going back to the point I made a slide ago, was only a slide ago, we're trying to make as much as we can from the trade, but least the risk amount. It doesn't mean it's really tight stops all the time, because it'll be a death by 1,000 cuts. But it means how can we structure the trade in a way that there's a sensible stop. Opening range breakout's a great example. We know the stop's probably going to be the low of that opening range, or half the opening range. We don't have to try and think about it. It's X dollars or X pips or X points, and we're expecting 4X, 5X, whatever it may be. And so we can structure it a little bit better, and that helps us not snatch our profits as well. Helps us not drag the stop up too early. Helps us not do the death by 1,000 cuts syndrome. So example here. A Palantir, which is on fire at the moment. Maybe you don't trade equities, but it's on fire at the moment. Gap up on earnings. Okay, fine. So we've had this structure. It gaps up on earnings. It messed around a bit, and then we kind of had a big momentum move. Great. So let's say you've categorized that as a trade you want to get long on. And again, I appreciate this is hindsight. I'm not here to say this is absolutely what you must do, but I'm here to kind of show you examples of something that, if you can categorize the gap, then this might be a good way of triggering into the trade. That's, we categorize the day or categorize the gap, come up with a framework and a roadmap. What's the trigger? Those three things then become valuable, because you're not second guessing yourself then. So opening range breakouts, a 5-minute chart there on the right, you'd frame the first 15 minutes and you buy above the break of the high. And that would have worked out great. You've categorized it, you've executed it, and you're done, and you're out at the end of the day, or whatever your exit strategy may be. Okay. Break of highs would be another thing. So very similar to the opening range break, but there's no structure in terms of time. So you've got this little gap here, and you could say that's a breakaway. Well, it was a breakaway gap, that little downtrend on the SPY. Sorry, not SPY, NASDAQ, Qs. I'm using the ETF as a Qs as a kind of proxy so I can see the gap on TradingView. And I might say, okay, you know what? I quite like that. Let it form a high first. Let it get a swing high. Let it pull back a decent amount. Then I'll take it on a subsequent break. So you might be like, well, why do you take this break? Well, maybe I want a reasonable pullback and a proper high put in before I take it. And yes, it's late to the day, but again, it doesn't matter. You're building a framework. And again, we're not hindsight traders going, oh, you should have bought it down here at this low. Yeah, but that point in time didn't look that great. And so you say, what's my trade trigger? My trade trigger is going to be, hey, if we put a swing high in, we reverse back, and then we take it out, then I'll take the trade. And you're coming up with that roadmap. And this is why I said at the beginning, this could be a strategy that complements your existing approach, in that there's a lot of, it's not systematic as such, but there's a lot of kind of boxes and filtering process that you can conduct before you even take the trade. And it takes a lot of the decision-making burden off you. You categorize the gap. Do I want to take it or not? Yeah. What do I think it's going to go? Oh, I think it's going to hit the 320 level. Okay. How do I want to get in? I use the ORB. No, I won't. I will, I'll wait for it to put a high and I'll take it. You can play that game. And then it becomes a simple case of waiting for the structure to occur, pull the trigger, and sticking to the rules. Another one which I like, and it's difficult to kind of really show you on a chart, but I hope you get this, and I'll linger on this for just a little bit longer because I really like this trade, or trigger, should I say. It's when we have and actually this on a daily chart, if you go back to kind of the COVID bounce we had, call it the COVID bounce, but that kind of rip off the lows, on a daily chart, this was super effective. But on an intraday chart as well, it's a 5-minute chart here, we've got an NVIDIA. Let's say you want to get in, so you're waiting for a break of the prior candle low that then comes back up and reclaims that. Why is this so nice? This is so nice because you can easily position a stop. So, hindsight traders would be long here. We're not hindsight traders. We're trying to figure out what the hell to get into this trade with a reasonable amount of risk. So this is one way of doing it. Rather than taking the high, we go, okay, once it's broken the prior candle low, I want to wait for it to come back up and I'll take it there. Now, the beauty of this is if it does a full scale reversal, it's not going to come back up through that low. So we take the low of this candle here. Did it break that? No. Next candle, did it break that? Yes, it's broken that low. It's come through. We're not interested. We're not interested. Now it starts to come back up. That triggers our long because it's that reversal structure. It breaks the prior low and reclaims within the same candle. So we're long. Our stop loss under that low. We let the trade play out. These can be very, very good trades. Now, the downside is with this slightly more aggressive entry, you're going to get stopped out more often. But if you get on the end of one, you can see for yourself, what's that, $1 risk, and this goes up $10. It's not unfeasible to see that. It's not going to occur all the time. Of course it's not, but that's how we trade it. The same here. We were looking, is the low broke? Is the low broke? No, is the low broke? Yes, it has. Okay, low's broke. If it kept going and going, wouldn't take it. But as it come back up the same candle, we take a long here and it stops below that. Now, I think, if you're executing that in real time, you might go, that's a little bit snug, that stop. And that's fine. You might say minimum of X, but that's the structure. And just looking at it that way. So break of the low as it comes back up, taking it through there, stop below the current low. Really good way of framing a trade. Really good entry strategy, I think. Yes, we missed one. Here's one. I thought we had. This is a little bit more simplistic. I have to say this is my least favorite, but I want to share because, hey, just because I do something doesn't mean it's the right way to do it. I want to share every kind of methodology with you. So this is when you wait for the first red and then you buy the new high. So this is a Netflix example. Again, we had loads of stuff gapping the other day, and it could be any instrument really. But as it starts to rally, wait for the first red. I like to use a 1-minute chart for this. Use a 5 or 3 potentially. Then you buy after the first break of the first red high. So you're buying at this sort of level here. Why do I not like it? I feel that we can do better personally, but it's a way of getting in. And I think that the key here, guys, is to really take away a lot of the burden we have intraday. Because intraday traders, whether you're trading gaps, whether you're trading whatever it is, there's a lot of things to think about. Is it long? Is it short? Should I trade this? Where should my stop be? Where should my target be? If we can add some kind of process, then I do believe that that's going to really help us in a certain way. It just helps us go, hey, well, I don't have to get involved. I don't have to worry about missing this. I'm waiting for my first red. And whatever or waiting for the low to break and coming back through, or whatever the structure. And by the way, if you were doing that on this one, your entry would have been here, because it broke the low of that candle, came straight back up. You longer with there, you stopped with there. It's a nice little trade. Anyway, one way to look at it, buying at highs. Okay, so we're in this. We've categorized the gap as best we can. We've come up with a roadmap. We've got a trigger or a couple of triggers. It doesn't have to be one. You can have a couple of those or have your own trigger, a way to get into the trade. Now we're in a position of power, right? So now we want to kind of look and see. And what we're doing now is we're looking at the data to reinforce whether that assumption on the gap type was correct. So after we see the gap, let's say we've categorized it as a breakaway gap. That's a very we've got an early categorization on that, and then obviously the further down the chart we go, the more likely it is, or unlikely, because we can see obviously the result. It starts to go higher and higher and higher, and there's 5 minutes left. Well, we know it was a breakaway gap. We know it was a runaway gap. So we want to categorize it as early as possible, because otherwise I can't make money at the hard right end of the chart. I can't earn money at the end of the day, should I say. We have to position early as possible. So we want to see price confirming the thesis. So in other words, this will be things like, if the price gaps up, and I'm using a lot of analogies, to the high side, but obviously you can flip them to the downside. But don't overcomplicate things. I think it's self-explanatory that we do just flip things to the downside. There's some nuances to trading downside gaps, upside gaps, slight differences, but details really. So lows tested but not held. In other words, gap up, we come back, it pops back up quickly. You can see those wicks. We see little wicks, comes down, but immediately bought. So it didn't spend much time to the downside. Every time it starts to penetrate to where it's come from, it gets bought back up. That's a really good kind of signal. This is some underlying strength here, and supply demand balance is on your side. If you use the VWAP, great way of looking, how much time we spent above the VWAP versus below the VWAP. And in a perfect scenario, the open is ideally the low of the day. That's a perfect scenario. So it's opened and it's just gone boom straight away, and it's gone up. Maybe it's paused, come back, it's stagnating a bit, still holding above VWAP. That's all good indications of strength. Versus opening, going lower, maybe coming up, coming down. That's more of a neutral type day, and you might want to hold back. You might go, what? Maybe I'll wait until for an afternoon high break, or maybe I'll adjust my trigger to be less aggressive. I'll wait for it to put a high in, come lower, and then I'll take it above that high. You can start to adjust and calibrate the way you trade based on what you see after the open. And you should do this, by the way, I think, for all types of trading. Whether you're trading gaps, whether you're trading, you're a forex day trader, whether you're trading indices, whatever you're trading. I think that being able to adjust and calibrate the way you're going to trade the market to the conditions is a real superpower if you can nail it. Because how many times are you kind of trading something, you see the momentum ignition, you jump on it, and it turns out to be just a flurry, and it runs out of steam. And of course, we're never always going to get it perfect. I know that, I know that. We live in the real world, guys. We trade the markets. We understand this is never ever going to be a perfect game. But if we just swing the odds more in our favor, it's such a fine line that's going to really help us out. Okay, so clues: the gap is exhausted. So we talked about what did we talk about here? We talked about we don't want to see it kind of running out of steam, and we don't want to see it just literally supply, demand, and balance just shutting off. So what about exhausting? The gap is exhausted. So something to really look for is if we gap and nothing happens. So Meta was a great example. We gapped up on earnings. It just sat there and it oscillated around the VWAP. That black line's the VWAP. We did a bit up, a bit down, and we just run out of steam. The volume just died right off. That's a nothing for me. You might categorize that as a breakaway gap. It's gapped up above the highs, gapped above this downtrend. Wow, it's got a catalyst. I'm in. I want this. I want to see the strength. But if it isn't, the data that we see isn't reinforcing that idea, then we leave it. Versus if it gapped and then just ripped up, paused, done another leg, you might be like, yeah, I'm in on this. People want in this. But for whatever reason, it just stagnated more and more. And it was a different opportunity, right? It was a different trading day. You could argue that it was extensions away from the VWAP, but we're not focusing on that today. We're focused on this gap opportunity. Counter trend move wasn't defended. It started to push lower. It was just a choppy, sloppy, horrible market. And these are the ones you want to avoid. I think that for most of us, the real nemesis is just choppy, sloppy conditions. It's not trading a really nice, clean market and getting it wrong. Ping, I'm stopped, fine. Oh, there we go. There's a nice 3-hour trade. Ping, I'm stopped. That works out in the wash. And generally, those volatile, nice, rhythmic conditions will work out for us. If we're focused on what we're trying to achieve and we've got a strategy and a plan, I think they work out okay. But this type of stuff is the nemesis. Sitting in here, you take a trade, you think it's going to break out, you buy it, comes lower, you're holding it, you're just sitting there. It just does nothing for your P&L, nothing for your mental capital, to be avoided at all costs. Different structure to what you'd expect is what we're doing, basically. We're just constantly checking. All right. So summary, got some time for Q&A, which is good. I'm on time, running well. Remember your gap types. So how are we categorizing that gap using the evidence we've got? And I think we'll probably do another webinar where we talk about this from a kind of whatever you trade perspective of going into the day, categorizing the day type. But important for this, hey, what do I think this is? Do I think this is a breakaway gap, or is it just a normal gap, common gap? And then how does it respond at the open to reinforce that categorization or not? Note down your plan of action. Get your pen and paper. Write it down. Hey, I'm going to wait for this. I'm going to wait for it to do this, do that. Wait for your trigger. Stick to the plan. And like anything, this is a game of discipline. This is a game of having a plan of action. This is a game of using your intuition a bit. I don't believe that we should just completely have so many rules that we shackle ourselves and we can't operate as a trader. We're discretionary traders. Most of us here are discretionary traders. We need that feeling, that gut instinct, that intuition to trade. So have some framework there, but also constantly just analyzing. Is this still valid? It's still valid. Yeah. Don't overthink things, because you don't want to be frighten yourself into not taking a trade or never taking a deal or closing a trade too early. But that constant, just test it with my intuition. You've got screen time. You've sat in front of the screen. You've seen a lot of price movement. Trust it. Trust the judgment. It's not always going to be right, but you don't want to berate it and hammer it down when it's wrong. And this is a completely separate topic, I know, but it's important regardless of the way we're trading, I feel. Okay. So next week, Wednesday next week, we're going to talk about fading. So the common gap trading mistakes, some real big blunders here that you can just avoid easily. You can easily avoid them. The gap fill fake play, I like that one. That's a good bread and butter type gap trading strategy. How to screen for gaps, so spend some time looking at that. The V-shaped reversal, that's sometimes the trading nemesis, that, but I'll give you some ideas on that, and you can kind of think for yourself whether you want to avoid that or get involved in it. Adding to winners, a little bit on that, and then I'll give you my gap fill testing tool for TradingView, and hopefully you guys go away, find some stuff that's of value to you. All right. What have you got for me questions wise, guys? By the way, I've got a podcast. If you want to listen to it, it's on Spotify. Just search for Traders Mastermind, Apple, all the other places. If you enjoy it, then appreciate your feedback on that. I think you can rate it there. If you don't enjoy it, be honest with the rating. That's fine. It's not going to hit everyone. And also, a daily email I do have for you. These are obviously of no charge to you, ladies and gents. Okay. I am looking on the other screen at the Q&A, and I'm going to scan through quickly. Mark says, sorry, I'm late. Traffic on the M6. Oh, the fun of the M6. I was on the M6 the other day, driving up to rainy Scotland. And actually, when you get past Lancaster, it's quite pleasant. But if you're going southbound, let's say from Manchester through to Birmingham and towards London, it's unpleasant. I feel your pain, Mark. Richard says, thank you, appreciate that. Linda says, how do you scan for gaps? We're going to do that next week, Linda. Good question, great question. You're thinking, and we are definitely going to do that, how we scan gaps, how we frame a small versus a large gap percentage. Jacob said, hi, Mark, great content as always. Thank you, Jacob. Love the YouTube videos, emails, podcasts, and webinars. Appreciate that, Jacob. Your feedback is appreciated, genuinely, it is. What win rate do you tend to look for when developing a new strategy idea? That's a good question. And do you know what? The textbook answer is, well, you're going to get 50, 60%. And then as long as you're getting a risk reward ratio of X, and that's cool, right? Because, if you tossed a coin 50% of the time, but you made twice as much as you did when you won and when you lost, your 2-to-1 risk reward ratio, then the maths all works out nice. And everyone's looking, and the statisticians and the data guys are going, yes, that's a very good way. But I think that it depends on personality type. Sometimes we want something that has a higher win rate, but maybe you don't make as much on the winners. So maybe you want a higher win rate. Maybe you want to be in the 75%. Maybe you want to be in the 70%. I know a trader who's got a really high win rate, and he maybe wins as much as he loses, but because that just suits his personality type of being able to sit there, and he wants more winners, doesn't like losers as much, and that's okay, right? We're human beings. So I think it's very personal. Where do you want to sit? Some people can sit in the other end of the scale and have loser, 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 and then a monster winner, and that wouldn't suit me. It wouldn't suit me at all. I don't think it would suit you, right? That's a very, very awkward place to be. So I think it's finding something that is the best of both worlds, has a reasonable win rate, 75 is great if you can get it. Some people are like, oh, you can't get 75, but it's possible. It's absolutely possible if you've got to miss a lot of stuff, right? You're missing a lot of stuff and you're kind of giving up, you're taking away one hand and giving with the other. Or do you go, you know what, I'm happy to be 50-50, but actually when I win, I'm going to make it 3 times as much. I think there's somewhere in between that. You can get to 50 to 75. I know some people are going, 75 is ridiculously high, but like I say, if you get the right conditions and a very strict setup, you might not get it all the time, but that's something that can be there. And then you go, okay, well, what's my risk reward ratio? How can I structure the trade? And that's why it's important, I think, to really think about where your entry is rather than where I think the price is going to go. How can I structure the entry so I have the least amount of risk possible sensibly? Which is why things like breaking through the low and coming back up are so powerful, I think, because it does give you a high risk reward ratio on the trade. That's a good question. I beat you around the bush a bit, that Jacob, but very personal. I think, what do you feel comfortable with? This is not a textbook answer, by the way. This is not what everyone tells you to do. But I just know from experience that how I feel when I take the trade is important, because I don't want to feel like I'm taking another trade, it's going to be a loser, because my confidence will start to, as you get further on and more experience, that becomes less impactful, because you've gone through periods of drawdown, you've gone through periods of, you've gone through the full emotions of trader. But between where you are in your journey, you don't want to be sitting through loser going, well, just got to stick with it because the numbers are going to work out, and this is the one that's going to. If you feel bad, you're not going to trade that way. So really audit your emotions with stuff, and it's nonsense to believe you can suppress them. Just acknowledge them and say, hey, I don't want a low win rate, I want a high win rate, but I'm prepared to give up the fact that I might not make as much on my winners. Or where you sit. I know a long-winded answer, Jacob, but this is the kind of stuff that I do like to discuss, and it was a great question. Okay. What's this question here? Linda's put, can we trade gaps in the 1 minute time frame? You can't trade a gap on the 1 minute moving, because unless the market is gapping for liquidity over earnings, over data, you won't get a gap. But if you're asking me if you can use a 1 minute after the gap on a daily, then yeah. I answer your question. Yeah, Robert Reed said, I think I read somewhere that 48% of gaps get filled. Are you aware of the stats for different gap types? This is what the tool will help you with, Robert. This is what the tool will help you with, because I've seen loads of different stats, and I've dug around and I've got this and got that. I want to see it from my own eyes. So this tool is going to help you go, right, gap of X%, going back this period of time, this filtering this criteria for gaps, how many times would that have worked? I.e., if I sell the gap and I close it filled. So yeah, that's a good question, but the results vary massively. And think about this, Robert. This is where this data becomes a little bit rubbish, in my opinion. What happened to cause the gap? What happened prior? If we get a gap that maybe gaps small amount, but it gaps above resistance, that's pretty significant, right? And the gap might only be a small amount, but the prior action beforehand really gave it some more clout than it would have had if you just looked at it objectively on its own, percentage-wise. And so this is where, if we can blend a perfect thing of some data to support the logic brain getting this logical, I know I should do this, versus, actually what we're seeing with supply demand, then I think that's the sweet spot. It's like when we trade, if you're trading an index, right? You're trading the Dow, S&P 500. We know that something ridiculous, like 80-something% of the time, it tags the overnight high or low, one or the other, right? So we know this type of stuff, but in certain conditions, you might be like, oh man, hang on, this is just, we've got CPI tomorrow. We ain't going to do nothing. We're going to sit here at the opening print and do nothing. But that wouldn't have come out in the data because there's an extra bit of variable that you haven't taken into account. So yeah, there's loads of data out there, and hopefully you can better dig into stuff yourself with this tool. I'll give you guys. Thanks, Robert. All right. What stocks do you trade gaps on? Thanks, it's been really helpful. Appreciate that, Linda. I think I'm going to go through the screening criteria next week a bit more depth, but you kind of want to have this window of, right, I don't want something too thin, that's super thin, that's going to cause me problems. And I want something that's reasonably thick and has some liquidity to it, some volume to it. But yeah, we'll go through that next week. So if you're registered for this webinar, you will get an email to remind you to come next week. And the recording obviously will send to you as well. Michael, that's a good name. That is a good name. And I'm going to butcher that, so I'm going to try. So thank you, Michael. How do you only trade according to gaps patterns? No, this is one strategy out of several that I'll deploy depending on the conditions. But obviously, the downside of this is you're not going to get gaps all the time. Earnings season, good time to be looking at gaps. Good time to be seeing news flow. When there's stuff going on, that's when you're going to get the gaps. But when there's no earnings season, you might get a few gaps. But I kind of think that it's one of those, if you're really focused only on this, you're going to end up taking really naff trades. So I think it's having that higher benchmark of, okay, I'll take that under those conditions. It's like the trend day trade. I've got a really powerful, what I think is a powerful trend day trade. But I will only use that on really strong trend days. So I haven't done it for ages, right? I haven't done it for ages because even though we've looked at it, it's been a reasonable trend, I've not seen the catalyst at the opening to take it. So, this is just one kind of strategy that I'll bolt in under the conditions. I think that answers your question. Mark says in the Leyland, not good. Is there a way to see a replay of the session? Jay, yes, it will be sent to you. Thank you. Yeah, it'll be sent to your email. Okay, a few more. How do you treat gap ups that are so extreme that stockholders are likely to just want to instantly lock in massive profits at the open? Yeah, good question. That to me would be, if it's so big, unless it's a really, reprice scenario, maybe there's a lot of people stuck short that have to get out. That could be, something extra that you look at. You might avoid it and go, hang on a second, this is so extreme that actually, who's going to buy up here? Who's going to buy? Now, this is where we get really kind of in depth of, okay, what's the environment we're in? Who are the participants? We used to have time when, everyone was buying gaps up and they just run because all the kind of, I call them the boxer short traders, the guy who come in and trade in their boxes with buying anything that was gapping up. And so you could take advantage of that. But now people are a bit more savvy, they've been burnt. And once they've been burnt on a few, they tend to not get that continuation. And it's not enough institutional interest to buy it there. And so there's a bit of nuances, but we'll go through that. That's a great question. Trevor, can the gap strategy be used for 1 minute scalping or are they used for higher time frame? Yeah, a little bit higher time frame, Trevor. You want to trigger on the 1 minute, but see the structure of the trade on the higher time frame. Melissa said, thank you, webinar has been helpful. What do you mean by S&D imbalance? Yes, sorry, I should have said, you're right. S&D is supply and demand imbalance. So supply being selling, demand being buying. When we get the imbalance, that's when we get price movement. If there's a lot more buyers, there's a buyer for every seller, so be very careful of that. But if the buyer is more aggressive, they're prepared to pay a higher and higher price. That causes price to move higher. The seller's more aggressive, they're prepared to pay lower and lower price, sell at lower price, that price moves lower. When we get that massive imbalance, that's when we get that move and people just want to get in or get out of the position. They don't care about the price. That's when we have more opportunity. Mark Pooley said, took a big risk reward on US 100, was sat at 5K runway round. It's only just gone in profit last 3 hours. Try for a 3-1, but a mighty 4% win rate, but losses are big. Okay, yeah, Mark, I think you can probably do better. And not in terms of win rate, but you probably know, hey, if I just remove my win rate lower and I can probably not have such brutal losses, but, great, if that's working for you, great. Small adjustments there of saying, okay, maybe I need to dial the win rate down. I can stomach 70 is still good, but I don't have so many, big brutal losses that, hurt your confidence, hurt your momentum. There's a sweet spot there somewhere. You've obviously got read and ability to reprice, but just making those little minor tweaks. Still doing around 10K a week with a 30K account. Very good, Mark. Trick is to give it room to move in your trailing stop and not too tight. Agree. What is your option? The best index you traded for gaps? I do love the DAX. I do love the gaps. I love gaps. I love the DAX. DAX, NASDAQ. NASDAQ's great because you can use the QQQ as a proxy. You can see the gap. And very often, when that thing just runs, it's going to run. And obviously, if you're trading from the UK, it's a nice time to trade. Yeah, both of those are cool, but I do like the NASDAQ. Thank you very much, Jacob says. I am, thanks, excited. Linda, thank you. Is a gap strategy valid for all markets or a market where it works better than others? Trevor, I would say it does work better in indices and equities. Those are the best. You will get occasional gaps at the weekend in your Forex pairs, but not as many. Obviously, you've got 5 days compared to just one opportunity for the currency pair to gap. Jay says, Thank you, Mark. Really appreciate the great insights you're providing. Appreciate that, Jay. Thank you. Thanks, Mark. Ezadine says thanks. Last two questions will go here. What kind of fixed stop loss makes sense for this strategy? Is it better to use structured stop loss? That's a good question, Linda. I think you could start off with a fixed ADR percentage. So what's the average true range of the day? Maybe use 25% of that. I'm not a big fan. I prefer structured. So I have to say, is that the right way of looking at it? Maybe not, but I like to say that point is where the trade is no longer valid. So we're taking the opening range breakout. If it comes back and takes out the low, it's no longer valid. I'm wrong. And so I think thinking through the lens or looking through the lens of, hey, is there a place is there a position I can place the stop that negates the whole thesis? I'm using those stupidly complicated words there unnecessarily, but that makes the trade invalid, right? You want to get to I think that's a better way of doing it. But I will add this: if you find yourself getting stopped out a lot, then go wide, use a percentage of a daily range, and then see how you get on with a lower position size, and see what the results are like, and then go, I'm doing okay with that. Just when I introduced a stop loss, it was messing up the results, right? So actually, what I need to do is put more effort into my stop loss. That's the lever I need to adjust. Susan said, thank you, Mark. I'll need to rewatch. Very interesting. Looking forward to next week's session. Thank you, Susan. Appreciate your feedback. See you next week. Are you trading weekly option expiry for gap fill strategies? Not myself, I'm not, but you absolutely could. You absolutely could. Completely agree, and always great content. Thank you. This is Mark in response to, I guess, my reply. Are you doing a paid training? As if you are, sign me up right now. I've got Traders Mastermind, Mark. You can join me on that. It's not very expensive. Join the group if you fancy joining that, or you've got the podcast and other bits and pieces. How to get used to bigger size. That's a separate topic in itself, Sindri. That is really a separate topic, because very quickly, if anyone's still here, there's a few people still here, you've got this line, right? And on this end of the line is small size. On this end of the line is stupidly big size. This end of the line, you don't care. Let's say 1p a point, right? You don't care. You lose 10p, 20p, 50p. No one cares. It's irrelevant. Now, this end of the line, let's say you're doing £100,000 a point. You lose 10 points, 20 points, that's 2 million quid. For most people, you're going to care about 2 million quid. Maybe Jeff Bezos doesn't care. Or maybe if you're running a fund, you don't care. But there's some point where that's silly. Or for Jeff Bezos, maybe he cares about 100 million. I don't know. But at some point, there's like two extremes, where one you really, really care and one you really, really don't care. Your job as a trader is to find out on that line where you get to a point where you don't care and you can make as much as possible. Now this is a separate topic and a really good question. I don't want to go off piste here, but you get to a point where you tip over, you're trading so much size that you care so much you don't trade the same. So you need to back it off and go, hey, I'm trading a size that I'm okay with, I'm comfortable with. And really it's literally a scale that goes dink. When you get over a certain point, that's pounds per point or size or risk, you suddenly start caring too much, you trade differently, you snatch your profits a lot. And it's your job is to find where you fit on that scale. Oh, I care so much about this, I'm worried about this. Oh my God, that's a meaningful amount of money. Back off until you're comfortable. Whole topic, but really good question. Thanks, Mark Gordon. Thank you. Very interesting, Leslie says. Appreciate that, Leslie. Great session, Mark. Can't wait for next week. Says Andre. Thank you very much, ladies and gentlemen, for your attention. I'll be back next week on Wednesday. Peter, if you're in Traders Mastermind, Peter will be on the call right this second. And enjoy your evenings. Take care. Bye-bye.